Well, good morning, and everyone, and welcome. I'm Barbara Vanich, Chief Auditor and Director of Professional Standards here at the PCAOB, and it's my pleasure to get to be with you today, some of you in person. I would like to welcome to this meeting of the Standards and Emerging Issues Advisory Group members who have joined us in person and online, observers, board members, and those along with the public watching this meeting. We have a full agenda today. First, Chair Williams will have a few remarks for you, and then I will provide a brief standard-setting update, and our project leaders will provide you with an overview of the board's recent proposals on non-compliance with laws and regulations, and the amendments related to aspects of designing and performing audit procedures that involve technology-assisted analysis of information in electronic form. After that, the Office of Economic and Risk Analysis will provide you with an update on our post-implementation research plan for the supervision of other auditors, and we'll have a few questions for you for your input. As you may recall, we announced at the last meeting the formation of the Emerging Issues and Audit Subcommittee. Since then, the subcommittee members have met, and today we'll run breakout sessions on several topics. After lunch, we'll have a debrief on the breakout sessions, and then we will have a session on interim financial statement reviews, a standard-setting project that was recently added to our midterm agenda. We've built in plenty of time for comments throughout the meeting. As a reminder, if you would like to say something, for those of you who are in person, please put your tent card on its side. For those of you attending virtually, please use the raise your hand function. If that's not working, again, just type something in the chat. For those of you in the room, please make sure to turn on your mic and speak directly into the mic so that those people who are participating via web stream will be able to hear your remarks. We'll try to call on you in order, and thank you for your patience. If for those who are participating online have technical difficulties, please reach out to Brian Goodnaw. And now my final responsibility here is to state that for all representatives of the PCAOB speaking at this meeting, the views expressed by each of us are our own views and do not necessarily reflect the views of the board, its members, or staff. As mentioned, Chair Williams has some opening remarks. If you don't mind, please hold any questions until after we complete the standard setting update. Chair Williams.
Thank you, Barb, and thanks to all of you for participating today. It's really wonderful to be back in person. Before we begin, I want to provide the standard disclaimer that the views I express here today are my own and do not necessarily reflect the views of my fellow board members or the PCAOB staff. Since we last met, our dedicated PCAOB teams have been hard at work continuing to further our key goals of modernizing our standards, enhancing our inspections, and strengthening our enforcement. You'll hear more about our progress on modernizing our standards in a moment from Barb and her team. Thanks to their hard work, earlier this week, we proposed amendments to give auditors additional discretion addressing specific aspects of designing and performing audit procedures that involve technology-assisted analysis of information in electronic form. The use of technology by auditors and financial statement preparers never stops evolving, and PCAOB standards must keep up to fulfill our mission to protect investors. This week's proposal is informed by our research project on technology. That project remains active, and insights from it may give rise to new standard-setting projects while also informing the scope or nature of our other standard-setting and rulemaking proposals. Earlier this month, we proposed for comment a new standard on noncompliance with laws and regulations, or NOCLAR. When sanctions, fines, and civil settlements directly affect a company's bottom line or reputational damage causes a company's stock value to decline, investors pay a price. The new proposed standard aims to better protect investors by strengthening the requirements for auditors to identify, evaluate, and communicate information that may indicate a company's noncompliance with laws and regulations. In March, we issued proposed changes to modernize a suite of standards that address core auditing principles and responsibilities, including reasonable assurance, professional judgment, due professional care, and professional skepticism, known as AS1000. The proposed changes will center investors by making clear that auditors have a fundamental obligation to protect them. Your feedback will be vital as we continue, and we look forward to hearing from you on all of our proposed standards. As much progress as we are making on standards, there is still much work ahead of us. In May, we updated our agenda, moving important projects up to the short-term agenda, including firm and engagement performance metrics, and adding new projects and several rulemaking projects, which Barb and her team will cover in more detail in a moment. At the same time, George and his team in inspections have been hard at work, and our teams inspect roughly 800 audits in more than 30 jurisdictions around the world each year. Last year, we expanded the PCAOB's reach even further by securing access to inspect completely in China for the first time in history. In May, we released the inspection reports for a firm located in mainland China and another firm headquartered in Hong Kong, which we inspected in 2022. The deficiencies we found were unacceptable, and we are using every tool in our toolbox to hold the firms accountable for fixing them, including shining a light through our public reports and referring inspection findings to our enforcement team where appropriate. If enforcement violations are found, we will not hesitate to order sanctions, including imposing significant monetary penalties and barring bad actors from performing future audits. The fact that our inspectors found these deficiencies is a sign that the inspection process worked as it is supposed to. Of course, last year was just the beginning of our work. Firms in China and Hong Kong will be inspected on a regular basis going forward. Inspectors have begun fieldwork for China and Hong Kong firms for 2023's inspections, and we anticipate that this fieldwork will continue off and on throughout most of the year, which is common practice for inspections such as these in jurisdictions around the world. We are continuing to demand complete access with no loopholes and no exceptions, and should PRC authorities obstruct or otherwise fail to provide complete access in any way, at any time, the board will act immediately to consider the need to issue a new determination. In May, we announced enhancements to make our inspection reports more transparent, with a new section on auditor independence and a range of other improvements to make more relevant, reliable, and useful information available to investors and other stakeholders. This was just a first step, not a final step. We are continuing to look for more ways to expand the information available in our reports. Many of you have also heard me speak about a troubling trend in audit quality, as our inspectors have found an increased number of Part 1A deficiencies. A third of the audits we inspected in 2021 had deficiencies of such significance that the PCAOB staff believe the audit firm failed to obtain sufficient appropriate audit evidence to support its opinion on the public company's financial statements or internal control over financial reporting. In December, I challenged auditors to sharpen their focus and prioritize their efforts to increase audit quality and ensure investors are protected. And the PCAOB is working to continue to hold firms accountable for improving audit quality by modernizing our standards, enhancing our inspections, and strengthening our enforcement. In April, George and his team released a spotlight outlining their inspection priorities for this year, and it tackles the challenges we are seeing to audit quality head-on. Our inspection priorities are designed to stay ahead of new and emerging risks, hold firms accountable, and drive improvements in audit quality for investors. That includes increasing the focus on fraud-related audit procedures, continuing to prioritize risks on material digital assets, also known as cryptocurrency, and continuing to select audits in the financial services sector for inspection. Of course, these are just some of our priorities. Our spotlight publications related to our oversight activities include much more information along with helpful reminders for auditors. Earlier this month, the inspections team released a spotlight related to audit procedures performed to crypto assets that are material to the financial statements. The spotlight addressed inspection observations, good practices, and reminders for auditors when auditing crypto assets. And just last week, the inspection staff released another spotlight with helpful questions for audit committees to consider as they carry out their oversight and engage in steady dialogue with auditors throughout the world. And throughout the audit. Finally, as you know, this board has committed to strengthening enforcement so that bad actors know there will be consequences for anyone who puts investors at risk. Last year, we imposed the highest penalties ever, and we doubled the number of enforcement orders from the previous year. In March, we were proud to announce Bob Rice has joined us as our new head of enforcement, and just last week, we announced another record-breaking sanction with the largest ever penalty imposed on a non-affiliate firm. Bob has more than 30 years of white-collar litigation and investigations experience, including in the private sector, and a long history of public service and government. He's hit the ground running, and his decades of experience holding wrongdoers accountable are already proving invaluable to our continued efforts to keep investors protected. Thank all of you for being here and for all of the hard work and time that you dedicate to the SEIAG. I would now like to turn the floor back over to Barb to get us started on today's agenda. Thank you.
Thank you, Chair Williams. Chair Williams touched on some of our standard setting activities, so I'll just fill in with a little bit more detail. So since we last met, the comment period on our proposal, general responsibilities of the auditor in conducting an audit, the comment period closed at the end of May. As of this week, we had received about 26 letters. Our team is currently analyzing those letters and will be working with our board in the upcoming weeks and months to determine next steps. In May, we updated our standard setting and research agenda. We updated our projects on quality control and confirmations to reflect that the staff anticipate making recommendations in 2023 for the board to adopt those standards. We also moved to the midterm agenda on, we also moved our midterm agenda project on substantive analytical procedures to the short-term agenda. We anticipate recommending a proposal to the board in 2023. In addition, we moved our project on firm and engagement metrics from the research agenda to the short-term standard setting agenda. We also anticipate making a recommendation to the board on this project this year. We continue to work with the board on all short-term standard setting projects, and the staff continue to make progress on our midterm project. We're excited to hear from you today during our session on interim reviews. We continue to evaluate the interim standards, and as a result, we added a project on AS 2601, use of a service organization, to the midterm agenda, which would consider whether that standard should be amended to reflect changes in the nature and extent of how companies use services of third parties that are relevant to the company's own internal control over financial reporting. We look forward, again, to your input on our standard setting project on interim reviews later today. We also added a new section to the public agenda that addresses rules that are beyond our professional standards, and those include projects on contributory liability, which would consider changes to the board's contributory liability rule, which is 3502, the responsibility not to knowingly or recklessly contribute to violations. We added a project on firm reporting and transparency, which would consider changes to audit firm reporting requirements, including periodic and special reporting requirements, along with other enhancements to our reporting framework. We added a project on registration, which, as the name suggests, would consider changes to our registration program, along with a project on follow-on disciplinary proceedings, which would consider amendments to our rules to provide for expedited follow-on disciplinary proceedings against registered firms or associated persons who've been convicted of certain crimes or enjoined or sanctioned by a court or another regulator. In June, as we've already mentioned, the board approved 2 standard setting recommendations. Next, we'll have our project teams on non-compliance with laws and regulations, along with our project leader on the data analysis amendments, give you a brief overview of those proposals. So starting with non-compliance with laws and regulations, or NOCLAR for short, Lisa, could you go ahead and give us our overview?
Thanks, Barb. Sure. Good morning, everyone. On June 6th, the board approved a proposal on the auditor's responsibility for the consideration of a company's noncompliance with laws and regulations, including fraud, when performing an audit. This proposal seeks to better protect investors from the resulting harm when the effect of noncompliance has a material effect on the financial statements and it goes undetected. In addition, the proposal aligns with the board's strategic plan to modernize existing standards. The proposal would replace the standard related to illegal acts by clients, as well as amend other related PCAOB standards. Existing AS 2405 was adopted by the PCAOB in 2003 based on a standard issued by the AICPA in 1988. The existing standard predates the enactment of federal securities law provisions that fundamentally altered the auditor's responsibilities for detecting and responding to illegal acts, namely Section 10A of the Securities Exchange Act. Additionally, the Sarbanes-Oxley Act included provisions related to corporate governance, among others, that have led companies to develop more sophisticated ethics and compliance systems. We have considered these changes in developing our proposed requirements that would apply to all audits performed under PCAOB standards. The proposal enhances the auditor's responsibility for the identification, evaluation, and communication of noncompliance with laws and regulations. Auditors plan and perform the audit to obtain reasonable assurance that the company's financial statements are free of material misstatement, whether due to error or fraud. Some laws and regulations relate to the manner in which matters are presented in the financial statements. Other laws and regulations may relate to operations of a company. With respect to all laws and regulations, misstatements of the financial statements can arise when violations occur and are not properly presented, that is, recorded or disclosed in the financial statements. Current AS 2405 states that the auditor's responsibility to detect and report misstatements resulting from illegal acts having a direct and material effect on the determination of financial statement amounts is the same as that for misstatements caused by error or fraud, and has few requirements related to the auditor's identification of noncompliance with other laws and regulations that have a more indirect relationship with the financial statements. You'll notice one key aspect of the proposal is the removal of this direct-indirect distinction. Rather, the proposal would focus the auditor on those laws and regulations with which noncompliance could have a material effect on the financial statements, which I'll sometimes refer to as identified laws and regulations. I'd like to start today by saying a few words about the proposed meaning of noncompliance with laws and regulations. The proposal would replace the term illegal acts with noncompliance with laws and regulations. The proposed meaning of noncompliance with laws and regulations would encompass any act or omission, intentional or unintentional, by the company whose financial statements are under audit, or by the company's management, its employees, or others that act in a company capacity or on the company's behalf that violates any law or any rule or regulation having the force of law. Under the proposal, noncompliance with laws and regulations includes fraud as described in AS 2401, consideration of fraud in a financial statement audit. That is, an intentional act that results in a material misstatement of the financial statements that are the subject of an audit. Noncompliance with laws and regulations does not include personal misconduct by the company's personnel unrelated to the business activities of the company. The proposed definition would encompass a wide variety of conduct, including embezzlement of company funds, misappropriation of assets, or payments of bribes, as well as other conduct that has financial consequences to the company, such as violations of employment, occupational safety and health, antitrust, and privacy laws and regulations. And, consistent with the existing standard, noncompliance with laws and regulations would not include personal misconduct unrelated to company business. The new term would focus the auditor on noncompliance whether the violations concern financial or operational issues, or involve intentional or unintentional conduct. As mentioned, the proposed definition of noncompliance with laws and regulations would expressly include fraud as described in PCAOB auditing standards. Importantly, while the PCAOB standard related to an auditor's consideration of fraud in a financial statement audit would continue to govern the auditor's responsibilities with respect to identification of information that may be indicative of fraud, the evaluation and communication of fraud would be addressed by the proposed standard, and those requirements would be applied in the same manner as for other forms of noncompliance with laws and regulations. The proposal would require the auditor to identify those laws and regulations with which noncompliance could reasonably result in a material effect on the financial statements without regard to whether the effect could be viewed as direct or indirect. Again, these are the identified laws and regulations. The proposal sets forth 3 other objectives for the auditor also to assess and respond to the risks of material misstatement arising from noncompliance with the identified laws and regulations. Identify whether there is information indicating noncompliance has or may have occurred, and evaluate and communicate when the auditor identifies or otherwise becomes aware of information indicating noncompliance with laws and regulations, including fraud, has or may have occurred. The proposed objectives would create requirements for the auditor that I'll briefly discuss in connection with the related proposed requirements. First, the proposal would establish an unconditional responsibility for the auditor to plan and perform procedures to identify laws and regulations with which noncompliance could reasonably have a material effect on the financial statements. The phrase "could reasonably have a material effect" as used here is intended to enable auditors to tailor their planned procedures to focus on those laws and regulations that relate to the matters are presented in the financial statements and other laws and regulations that may relate to the operations of a company with which the company's noncompliance could reasonably result in material penalties, fines, or damages. These laws and regulations would necessarily be relevant to the company or its operations, but would not represent every law or regulation to which the company is subject. Next, upon identifying the laws and regulations with which noncompliance could reasonably have a material effect on the company's financial statements, the proposal would require the auditor to plan and perform procedures to assess and respond to risks of material misstatement of the financial statements due to noncompliance with those identified laws and regulations. To facilitate this identification, the proposal includes enhanced risk assessment requirements for the auditor to obtain an understanding of the regulatory environment. That includes a proposed description of the nature of the laws and regulations the auditor would understand as part of the audit. In addition to the procedures for obtaining an understanding of the regulatory environment, the proposal includes more specific procedures for obtaining an understanding of management's processes related to preventing, identifying, investigating, evaluating, communicating, and remediating instances of noncompliance with laws and regulations. Processes for receiving and responding to tips and complaints from internal and external parties regarding noncompliance, including those received through any whistleblower program that exists. And processes for evaluating potential accounting and disclosure implications of noncompliance with laws and regulations. And making and evaluating inquiries to management, the audit committee, the internal audit personnel, and others who might be reasonably expected to have relevant information. These inquiries and other procedures complement the existing risk assessment requirements. These inquiries would focus on instances or alleged or suspected instances of noncompliance with those laws and regulations for which noncompliance could reasonably have a material effect on the financial statements. The proposed inquiries would inform the auditor's initial assessment of risks of material misstatement, including risks due to noncompliance, and are similar in nature to those in existing illegal acts by clients auditing standard. The proposal integrates the new and enhanced requirements into the existing risk assessment standards, underscoring that noncompliance could affect the risk of material misstatement of a company's financial statements, and helping avoid any misperception that the auditor's consideration of noncompliance exists in a silo or should be performed as a discrete step in the audit. The performance of these procedures would also inform the auditor's understanding of how noncompliance could have a material effect on the financial statements and enable the auditor to assess and respond to the related risks of material misstatement. In addition to these risk assessment procedures related to consideration of noncompliance, the proposal includes certain amendments that are intended to generally enhance the auditor's risk assessment procedures that we believe would have broader benefits to the audit, such as requiring the auditor to read publicly available information about the company, including information made available by the company and other sources external to the company, as well as information publicly disclosed by the company's executive officers about the company. The proposal's third objective is for auditors to identify whether there is information indicating noncompliance with identified laws and regulations has or may have occurred. The proposal would require auditors to plan and perform procedures to identify whether there is such information indicating noncompliance. Under this approach, the nature and extent of procedures that auditors would plan and perform to identify whether there is such information would depend on the specific facts and circumstances of each audit engagement. The population of laws and regulations for which the auditor would plan and perform such procedures would be those the auditor assessed could reasonably have a material effect on the financial statements. As part of planning and performing such procedures, the proposed amendments would require auditors to use information obtained from their risk assessment procedures, including the procedures included in the proposed amendments, and from other procedures performed in the course of the audit of the financial statements, reviews of interim financial information, and, if applicable, the audit of internal control over financial reporting to identify information indicating noncompliance has or may have occurred. Again, the amendments continue to underscore that the process for identifying information indicating noncompliance has or may have occurred is not a discrete process. It is integrated throughout the audit, and at any point during the audit, the auditor may identify or otherwise become aware of such information. When the auditor has identified or otherwise become aware of such information, including potential for fraud, has or may have occurred, the proposal would require the auditor to evaluate and communicate such instances, regardless of whether the effect of the noncompliance is perceived to be material to the financial statements. These procedures for evaluating and communicating information would apply equally to all information indicating noncompliance with laws and regulations, including those indicating fraud, has or may have occurred. For purposes of evaluating information, the proposal sets forth requirements for the auditor to obtain an understanding of the nature and circumstances of such noncompliance and determine whether it is likely that any such noncompliance occurred. The proposal establishes a threshold for evaluating noncompliance with laws and regulations that is similar to the threshold for evaluation that currently exists in Section 10A, that requires evaluation when a firm detects or otherwise becomes aware of information indicating that an illegal act has or may have occurred, whether or not perceived to have a material effect on the financial statements of the issuer. Under the proposal, the extent of procedures necessary would depend on the nature and circumstances of the matter, including whether the matter could be material, the relevance and reliability of information provided by the company about the matter, and the effectiveness of management's process for investigating the matter. While the auditor can apply judgment to determine the nature and extent of procedures to evaluate information indicating noncompliance has or may have occurred, and may include inquiries in their procedures, the proposal notes that inquiries alone would not be sufficient to determine that noncompliance did not occur. That is, that noncompliance is unlikely. The proposal does acknowledge, however, that inquiries alone may be sufficient to determine that noncompliance is likely to have occurred. Once the auditor determines a matter is likely noncompliance, the auditor would be required to determine the possible effects on the financial statements and the implications of such likely noncompliance on other aspects of the audit. The proposal would also add a requirement for the auditor to perform additional procedures as necessary to determine whether the likely noncompliance results in other information in documents containing audited financial statements or the matter of its presentation being materially inconsistent with information appearing in the financial statements or containing a material misstatement of fact. The proposal recognizes that some likely noncompliance may have an impact on other information accompanying the audited financial statements and reminds auditors that they have an obligation with respect to other information under PCAOB standards. Additionally, the proposal would require the auditor to assess the implications of likely noncompliance on other aspects of the audit and take appropriate action. For example, the auditor may identify new risks of material misstatement in a particular account or disclosure that are based on the identified likely noncompliance for which the auditor may need to design and perform additional audit responses. In the event that the auditor determines that likely noncompliance has a material effect on the financial statements, the proposal includes a requirement to evaluate the timeliness and appropriateness of management's remedial action, a requirement established to help the auditor fulfill a requirement under Section 10A. There may be instances where remedial actions are ongoing or only planned at the time the auditor is expected to issue the audit report. In such circumstances, it is expected that the auditor would determine if the actions taken up until the time of the report issuance are appropriate and whether the auditor's standard report is required to be modified. In an integrated audit, the auditor would also consider the effect of such ongoing remedial action on the effectiveness of internal control over financial reporting. The proposal also enhances the auditor's communication to management and the audit committee. When the auditor identifies information indicating that noncompliance with laws and regulations has or may have occurred, whether or not to be perceived to have a material effect on the financial statements, the proposal would require the auditor to, as soon as practicable and before the issuance of the engagement report, communicate the auditor's understanding of the nature of the matter and the circumstances of its occurrence to the appropriate level of management as well as the audit committee, unless the matter is clearly inconsequential. As soon as practicable means that a communication is made in sufficient time to allow the recipient to use the information to take necessary actions. The as soon as practicable timing also aligns with the requirements for such communications in Section 10A. Additionally, if the auditor determines that a matter is likely noncompliance, the auditor would communicate the possible effect of the noncompliance on the financial statements and other information in documents containing the auditor's financial statements. In certain circumstances, the proposed standard allows auditors to limit their communication to management and the audit committee to reduce redundant communications. After the auditor has completed the evaluation of information indicating noncompliance has or may have occurred, the proposal would require the auditor to communicate to management and the audit committee, unless the matter is clearly inconsequential, the results of the auditor's evaluation, including which of the matters were determined to be likely noncompliance and for each instance of likely noncompliance, whether it has a material effect on the financial statements. The proposal would also require the auditor to determine the effect of any likely noncompliance on the engagement report and the ongoing relationship with the company. The proposal includes specific coordinated procedures and communications concerning noncompliance when auditor specialists or other auditors participate in the audit. These proposed requirements would address two-way communication between the lead auditor and the other auditors or auditor specialists, and would improve the auditor's consideration of a company's potential noncompliance with laws and regulations, given auditor specialists or other auditors involved in the audit may be the first engagement team members to become aware of fraud or other noncompliance. The proposal also includes amendments to other PCAOB standards that relate to noncompliance with laws and regulations. A requirement for the auditor to evaluate implications for the audit when transactions or relationships with a related party indicate noncompliance has or may have occurred, regardless of whether the company disclosed such transactions or relationships to the auditor. And amendments to the standard on reviews of interim financial information that would provide specific procedures, including additional inquiries related to potential noncompliance. Now, that's a brief summary of the No-CLAR proposal. As a reminder, the comment period ends on August 7th. Now let me pass the floor back to Barb.
Yeah, thank you, Lisa. Donna Silknitter will now provide a brief overview of our proposed amendments related to aspects of designing and performing audit procedures that involve technology-assisted analysis of information. And I will tell you, it's brief, because the only thing I want to convey to you is this is really a first step for us. This is based on some research, and as you know, we continue to do research, and the board has the TIA group there to advise them. So Donna, with that, I'll hand it over to you.
Thank you, Barb. Good morning. And as Barb and Chair Williams have mentioned, this week the board issued a proposal on amendments related to aspects of designing and performing audit procedures that involve technology-assisted analysis of information in electronic form. As the title suggests, and as Barb has mentioned, the amendments address some aspects of auditors' use of technology in audits. But to be sure, the amendments are not designed to be the answer to the use of technology by auditors. Rather, they are a stepping stone, a part of the PCAOB's effort to improve investor protection by modernizing our standards. As the use of technology in audits continues to evolve, we continue our efforts to stay abreast and lead the way in developing a robust framework of requirements that reflect the current state of practice and meaningfully contribute to investor protection. The use of technology-assisted analysis in audits is not new. What has been changing is the scope and sophistication of the auditor's analysis. Auditors have been increasingly able to obtain and analyze more information in different ways, do it earlier and throughout the audit, and identify more items for further investigation. With that, new, more specific questions have arisen about the effectiveness of our standards. And although auditors are able to use technology under existing PCAOB standards, the amendments would address aspects of designing and performing audit procedures where we have identified the need for additional specificity or clarity in the existing standards. These aspects include areas where PCAOB reviews of audits have identified instances of noncompliance with PCAOB standards, and areas where auditors have raised questions during our research regarding the applicability of PCAOB standards to the use of technology-assisted analysis. The proposed amendments would amend aspects of AS 1105, audit evidence, and AS 2301, the auditor's responses to risk of material misstatement, that have been substantially unchanged since the board adopted them in 2010. The proposed amendments are principles-based and therefore are intended to be adaptable to the ever-evolving nature of technology. This morning, I'll cover the main aspects of the proposed amendments. First, technology-assisted analysis is often referred to in practice as data analysis or data analytics. And the use of this terminology in practice and the use of the term analytical procedures in PCAOB standards have led to questions about whether an audit procedure involving technology-assisted analysis can be a test of details, meaning not an analytical procedure as described under PCAOB standards. And this distinction is important because PCAOB standards require that the auditor perform test of details when responding to an assessed significant risk of material misstatement. Under PCAOB standards, performing only analytical procedures would not be sufficient to address the significant risk. The staff have observed that auditors use technology-assisted analysis in both audit procedures that fall under the definition of analytical procedures and those that involve testing the details of accounts and disclosures. The proposed amendments would more specifically outline differences between test of details and analytical procedures under PCAOB standards by further clarifying the meaning of the term test of details. The proposal explains that a test of details involves performing audit procedures with respect to individual items included in an account or a disclosure, whereas analytical procedures generally do not involve evaluating individual items unless those items are part of the auditor's investigation of significant differences from expected amounts. Second, our research also indicates that determining the appropriate level of disaggregation or detail of information that the auditor is using as audit evidence is important for obtaining audit evidence that is relevant in supporting the auditor's conclusions. The proposed amendments would emphasize that the relevance of audit evidence depends on the level of disaggregation or detail of information necessary to achieve the objective of the audit procedure. Third, the proposed amendments would specify the auditor's responsibilities when using audit evidence for more than one purpose. Under PCAOB standards, the purpose of an audit procedure determines whether it is a risk assessment procedure, test of controls, or substantive procedure. The proposed amendments would specify that if an auditor uses audit evidence from an audit procedure for more than one purpose, the auditor should design and perform the procedure to achieve each of the relevant objectives. And this amendment would supplement existing direction in PCAOB standards and address situations identified in our research where auditors could potentially perform multi-purpose procedures involving technology-assisted analysis concurrently. Fourth, the proposed amendments would specify an auditor's responsibilities regarding assessing specific items identified by the auditor when designing and performing substantive audit procedures. Our research indicates that auditors use technology-assisted analysis to identify specific items within a population, so within an account or a class of transactions, for further investigation. Under the proposed amendments, the auditor's investigation should consider whether the identified items provides audit evidence that contradicts the evidence upon which the original risk assessment was based, indicate a previously unidentified risk of material misstatement, represent a misstatement or indicate a deficiency in the design or operating effectiveness of a control, or otherwise indicate a need to modify the auditor's risk assessment or planned audit procedures. As the auditor's investigation could be pivotal for identifying a risk of material misstatement or determining the appropriate response to risk, the proposed amendments would require the auditor, when inquiring of management, to obtain audit evidence to evaluate the appropriateness of management's response. The auditor's investigation may determine that a further, more focused iteration of the analysis is needed. And the proposed amendments would not prescribe the nature, timing, or extent of procedures for investigating the identified items. Because of the wide variety of analyses that may be applied by the auditor, it would be impractical to anticipate what a particular investigation could entail or what information it may provide to the auditor. Further, the nature, timing, and extent of an investigation including the number of items selected for further testing, would depend on whether it is conducted as part of the risk assessment when designing a substantive procedure or in response to an identified risk. And lastly, the proposed amendments would specify auditor responsibilities for evaluating the reliability of certain audit evidence. Our research indicates that in performing technology-assisted analysis, auditors use large volumes of information provided by a company that the company received from an external sources in electronic form. So for example, information regarding a purchase order submitted to the company by a customer, or regarding cash received by the company from a customer as payment for an invoice. Because a company can exercise certain control over the information it provides to the auditor, the proposed amendments specify certain procedures that the auditor would be required to perform to evaluate whether the information is reliable for purposes of the audit. The proposed amendments would also emphasize the importance of controls over information technology for the reliability of audit evidence. Lastly, the proposed amendments would update certain terminology to AS 1105 to reflect the greater availability of information in electronic form and improve the consistency of the use of such terminology throughout AS 1105. So thank you for your time, and I'll hand it back to Barb.
Okay, thank you. I don't see any tent cards up or hands up online. I'll give that a few minutes if anyone has comments or. Oh, just on that side. Go ahead.
Thank you. First, I just wanted to thank the staff so much for your outstanding efforts on standard setting. I'm very much supportive of modernization, particularly for the standards that Donna, you just went over on technology-assisted data. I think that's an important one that's going to be helpful to the profession. Given the rapid pace of change, I would encourage the staff to think about a holistic approach when you're thinking about effective dates for these standards. And maybe I think of it as mapping them out to do a gradual type of phase-in so that the firms can be ready with learning, with our tools that we do for implementation and other implementation guidance. I think that's particularly relevant as you think of global member firms and of smaller firms, and also for standards like Lisa, you talked about NOCLAR, did an excellent job. Thank you for that. On that one, I think there is some cases where it's expanding requirements versus just modernization. So in those cases, the effective date will need to consider, in my mind, additional resources that might be necessary for the firms, including specialists, in that case, perhaps legal specialists. But again, thank you for doing such a great job with so much work.
Thank you. Steve Morrison.
Good morning, and I agree completely with what Christine was saying. I think this is a tremendous effort, and I think it'll be a long way till quality. I think that to build on what Christine was saying about thinking ahead and staggering the dates, the one thing that kind of, not speaking against it, but a corollary thought, is that if the effective dates are staggered, consider that a lot of these things fit together. This is kind of like what you were saying a little bit earlier about not doing NOCLAR in a silo. A lot of these standards fit together in terms of the risk assessment, identification, response to the risk, and so forth, so that if the dates are staggered out, considered also if there's unintended consequences of that, say that year difference, where you might have one item becoming effective but a corresponding standard not becoming effective for another year or two. Could there be some implementation issues that would detract from quality, meaning having to stand up a response to one standard 1 year, off to really undo that or to make certain amendments in a couple of years. So some of the firms, even just the larger firms, have issues. Medium and smaller firms have issues with this as well. So it's just something to add on to what Christine was saying.
Thank you.
Brian Grotto.
Thanks and good morning. I too would want to congratulate the staff and appreciate all the work that's been done. And as everyone I think probably knows, I've been a long proponent of advancing audit standards, including the PCB's performance standards. I too would suggest, these are some complicated projects that you've undertaken, and particularly I think as Lisa's laid out, the no-CLAR proposal in particular, there's a lot of thorny issues to work through relative to things like scope and the role of management and compliance programs, and how one thinks about the competence of auditors and the skills of auditors versus lawyers and the involvement of specialists in the audit. There's a lot there. So when you think about that and the kinds of feedback that you're likely to get, I know it's premature on that. The comment period is open. When you think about 1,000 and the comments you're likely to, or that you are dealing with there, whatever, obviously this group can do or subcommittees could do to be helpful relative to further vetting, I would just encourage some thought on that, because I know that some of these are not ones that this body has really had a chance to have dialogue on, just given the timing, I think of it. So really would be supportive of anything the SEIAG or subcommittees of the SEIAG could do to be helpful as you work through what I know will probably be a large body of sort of feedback. I would just also like to mention on the spotlight documents that have been issued in particular, so the one that was mentioned on fraud, the crypto, we find those to be enormously useful, particularly the one on fraud. I think is an important read for audit committees management, and one that we're certainly going to use to to have that kind of a dialogue. And I do think that those kinds of documents can be enormously helpful, and so I appreciate what's been done there, and certainly encourage the use of those, and we're going to do what we can to promote the use, and our teams will be using those as well. So I just wanted to add those comments.
Thank you, Brian. Keisha Williams-Smith.
Well, good morning, and I too would like to thank the staff for moving forward this agenda. It is exciting times, even with a brief discussion. It was still exciting, and so kudos to the staff for moving this forward. Really quickly, I will just kind of echo a little bit of what we've heard in terms of the speed of even the standard, and the comment period I think is 60 days. It seems like it's about 60 days or so. But I would also think about, or have you all think about, any additional outreach, kind of to what Brian is saying. These are things that are very different, and I want to make sure that the comment process that will happen, but to make sure that the feedback is inclusive, so that we are making good strides with this modernization and not kind of leaving anyone behind, especially because it will cover a variety of audit firm sizes. So think about additional outreach opportunities after the comment period, and as Brian said, what we can do in this body, but I think it would be helpful, especially around no-CLAR, because I think some of that is making some folks clutch their pearls if they're from the South, and we really need to be mindful of that. So considering additional outreach to help make sure that the final standard is something that will be, I guess, will be appreciated by all the bodies that will implement it. Thank you.
Thank you for that helpful input. I don't see any other tent cards up, so thank you, Donna, and thank you, Lisa. And now we'll move to the next item on our agenda. We'll just take one moment to transition presenters. While my colleagues get organized here for just a second, so we plan to spend about the next 45 minutes providing a bit of a discussion on our plan for the post-implementation review on supervision of other auditors, along with seeking your input from you on several discussion questions. And I'm very happy to be joined here today by my colleagues from the Office of Economics and Risk Analysis, Wei Shi and Ricky Reber.
Thanks, Barb. Good morning, everyone. My name is Wei Shi, and I lead the post-implementation review team at the Office of Economic and Risk Analysis here at the PCAOB. Thank you very much for the opportunity for us to present here today. I think, as we recall, in the last two meetings, we provided this group with an overview of our PIR program, as well as a deeper dive into our two interim analysis, one on the critical audit matter or the CAMS requirement, and the other one on the new estimate specialist requirement. I think today we're going to provide this group with an overview of our plan analysis for the new supervision of the other auditors standard. So, which will become effective for the December 2024 fiscal year end audit. Our discussion today would touch on some of the statistical analysis we are already performing based on the pre-period data or the baseline data. And we also want to talk briefly about generally how we approach the PIR for these new requirements. We'll also tee up a few discussion questions in the end, and we're hoping to get your input into our plan analysis. I'm here today with our senior financial economist, Dr. Ricky Reber, who's leading this development of this project. And we're also joined remotely by our acting director, Mike Gerbett, which you may see or hear from the screen. With that, thank you very much for your time again, and Ricky.
Thanks, Wei, and good morning, everyone, and thank you for your time. As Wei said, my name is Ricky Reber, and I'm a senior financial economist in the PCAOB's Office of Economic and Risk Analysis. I'm excited to have the opportunity to talk to you about the PIR analysis for the revised requirements on the supervision of other auditors. I'll start today by providing you with some background on the other auditors rulemaking, or OA for short. I'll also present some pre-period statistical analyses that focus on the use of other auditors and deficiency rates observed on referred work engagements. Next, I'll walk you through our PIR evaluation framework and our planned analysis for the revised OA requirements. Finally, I'll open up the discussion for Q&A and ask for your perspectives and ideas. So first, let's take a step back, take a moment to explain what we mean by other auditors, and give you some context for this rulemaking. So the term other auditors collectively refers to accounting firms and individual accountants outside the lead accounting firm that issues the auditor's report. In these audits, sometimes called referred work engagements, the lead auditor issues the audit report on the company's consolidated financial statements, but other auditors often perform important work in the context of that audit. For logistical reasons, such arrangements are particularly common on large multinational audits. By way of example, we have a diagram here, so we'll consider this diagram that we've presented in the adopting release. Here we show three accounting firms, each serving a different role in the audit to demonstrate how a referred work engagement and a divided responsibility audit might work. So suppose accounting firm one, the lead auditor, is auditing a large multinational issuer with significant operations in the US, Japan, and France. In this situation, it's common for firm one to audit the issuer's US operations, but utilize non-US offices to perform audit procedures. Those non-US offices would be other auditors. I should note that this figure depicts the current regulatory environment in which firm one can choose between using firm two's work and reporting under existing AS 1205 or supervising firm two's work under existing AS 1201. Under the amended standards, this choice would go away, and firm one would be required to plan and supervise the work of firm two. I'll also point out that firms may also divide responsibility for that audit, as depicted on the right-hand side of the diagram, as option C. However, these situations are rare, and only about 40 or so per year, and that will not be the focus of our conversation today. This slide provides some background on the revised OA requirements. On June 21st, 2022, the PCAOB adopted amended requirements for planning and supervising audits involving other auditors. Those amended requirements will be effective for audits of financial statements with fiscal years ending on or after December 15th, 2024. The rulemaking amends several PCAOB auditing standards and is intended to increase and improve the lead auditor's involvement in and evaluation of other auditors' work. The amendments strengthen requirements for planning and supervising audits involving other auditors by applying a risk-based supervisory approach to the lead auditor's oversight of OAs and requiring the lead auditor to perform certain procedures when planning and supervising an audit involving OAs. Additionally, the board adopted a new standard that applies to divided responsibility audits, which are situations when the lead auditor divides responsibility for an audit with another accounting firm. However, as I mentioned earlier, these situations are currently quite rare in practice. As you can imagine, because the amended standards often come into play on large multinational audits, the role of other auditors has increased as issuers' global operations have grown. Therefore, it's important for investor protection that the lead auditor adequately plan and supervise the work of other auditors so that the audit is performed in accordance with PCAOB standards and provides sufficient appropriate evidence in support of the lead auditor's opinion in the audit report. In the next few slides, we've put together a few tables and graphs using publicly available Form AP data to illustrate the extent of other auditor usage. We'll also share statistics using internal inspections data on the occurrence of Part 1A deficiencies on referred work engagements. Hopefully, this analysis will provide you with a sense of the auditing environment surrounding the use of other auditors and help you get a better sense of historical trends. Because the amended standards are not yet effective, nothing in these slides should be interpreted to imply anything about the future interim analysis or future evaluation of the amended standards. However, as we walk through these slides, it would be great if you could think about the type of analysis you might want to see come out of our research and what we could publish that would be helpful to you. Okay, so what type of engagements use the work of other auditors? Looking at the data, we can see that between 2017 and 2021, approximately 29% of all engagements used other auditors. But as you can see, this is mostly a GNF story. Just for clarity, GNFs, or global network firms, are network firms affiliated with the 6 largest global networks: BDO, Deloitte, EY, Grant Thornton, KPMG, and PwC. NAFs, or non-affiliate firms, are registered audit firms that are not associated with these global networks. As you can see, for the 5 years of data presented here, approximately 46% of GNF engagements used other auditors, while only about 9% of NAF engagements used other auditors during that period. Over the past 10 years, for which we have data, an average of about 31% of referred work engagements have had a Part 1A deficiency. Deficiency rates peaked in 2012 at 40%, but more recently have hovered in a range between a low of about 26% in 2018 to a high of about 31% in 2020. In aggregate, across the population of all engagements, about 29% of engagements used other auditors in 2017. That proportion increased steadily to about 34% in 2019, and then decreased quite sharply to about 26% in 2021, the last year for which we have complete data. There are likely many factors driving changes in the use of other auditors over this period, and in particular, this decline observed in 2019 and 2020. Chief among them, however, is the proliferation of special purpose acquisition companies, or SPACs, around this time. As noted in the adopting release, SPACs rarely involve the use of other auditors. In fact, removing them from the sample, we observe only a slight drop in the proportion of engagements using other auditors between 2019 and 2021. It's also worth noting that SPACs are disproportionately audited by NAFs. About 90% of SPAC engagements in our sample were audited by non-affiliate firms, with the vast majority of the remaining engagements audited by US GNFs. However, as discussed before, other auditor usage is more common on audits performed by GNFs. So focusing our attention only on GNFs, we observe a divergent trend in the use of other auditors by US and non-US GNFs, beginning in 2019. OA usage among US GNFs was flat at about 46% between 2018 and 2019, before decreasing to about 42% in 2020 and 40% in 2021. The lowest level since 2017. On the other hand, OA usage among non-US GNFs increased steadily from 57% in 2017 to 62% in 2019 and 2020, before rising to more than 66% in 2021. Notably, the sample sizes here vary greatly between US GNFs, which is about 4,000 engagements in each year, and non-US GNFs, which is about 800 engagements in each year, which is why the aggregate trend shown on the previous slide more closely resembles that of US GNFs. Again, there are likely many environmental factors driving these changes in OA usage over time. While we cannot glean from the data any definitive answers about the cause of this divergence in OA usage between US and non-US GNFs, there are a few potential drivers we might explore. For starters, we know that some of the decrease among US GNFs is due to SPACs for the reasons I discussed earlier. Second, the decrease in the proportion of US GNF engagements using other auditors between 2019 and 2020 also makes sense if we think about what happened during that period, namely the COVID-19 pandemic. Out of necessity, COVID created a big shift toward virtual audits. Many firms realized that they didn't need to be, and in some cases couldn't be, physically on site to do audit work. It's possible that some firms decided to perform a virtual audit themselves rather than use a local affiliate to perform that work. Finally, we observe a reduction in non-US GNF engagements in the data. Essentially, part of the increase in OA usage between 2020 and 2021 is a denominator effect. The total number of non-US GNF engagements in our data decreased by about 2.6%, while the number of those engagements using other auditors increased by 4.5%. This was not true for US GNFs, where we observed an increase in total US GNF engagements of about 2.8%, but a 1% decrease in the number of those engagements using other auditors. If we hold constant the number of non-US GNF engagements from 2020, the proportion of engagements using OAs in 2021 would have been about 2 points lower. However, despite the upward trend in the proportion of non-US GNF engagements using other auditors, the share of total audit hours allocated to those other auditors has steadily decreased over time from about 33% in 2017 to 26% in 2021. On the other hand, among US GNF engagements, OA hours have been relatively flat, averaging about 14% of total hours since 2019. Across all engagements, we've observed a steady downward trend in the share of total audit hours allocated to other auditors over time. So what do we plan to do to assess the initial implementation of the amended requirements? In summary, subject to data availability, we will seek to measure and analyze the costs, benefits, and unintended consequences that we outlined in the economic analysis in the June 2022 adopting release. For example, we will seek to understand the extent to which the new requirements may have improved audit and financial reporting quality and the extent to which firms or issuers may have incurred costs. I'll flesh this out a bit more in the coming slides. Consistent with prior PIR work, the analysis will consist of a large sample econometric analysis and stakeholder outreach. Specifically, the staff will analyze relevant data, conduct surveys, and interview stakeholders. Finally, in light of the effective date, the PCAOB expects to produce a report no earlier than 2026 to communicate findings and perspectives on the initial impact of the new requirements. As we've discussed in prior SEIAG meetings, OERA staff evaluate PIR projects using 4 criteria. The first of those criteria is the magnitude of potential impacts. As outlined in the adopting release, we're thinking specifically about potential benefits, costs, and unintended consequences of the revised standards. With respect to potential benefits, we're thinking about improvements in the quality of other auditor work, improvements in financial reporting quality, and the potential for the amended standards to prevent or improve the detection of deficiencies in referred work by better aligning lead auditor incentives to monitor that work. We think about potential costs in various ways. First, we have auditor fixed costs. For example, costs associated with updating methodologies, tools, and training materials. Next, we have engagement level variable costs, such as additional time spent by lead auditors and/or other auditors. And finally, we have direct or indirect costs incurred by issuers. For example, costs related to supporting the work of auditors and/or the pass-through costs in the form of higher audit fees. Finally, the adopting release outlines several potential unintended consequences. For example, reduced OA involvement, OAs feeling less accountable, given that the amendments focus the responsibility for providing direction and supervision of the OA on the lead auditor, an inefficient allocation of audit resources. For example, if the increased supervisory responsibilities of the lead auditor reduce the amount of time engagement team members have to perform other work on that engagement, an increase in divided responsibility audits, that is, to avoid the requirements to supervise OAs under AS 1201, lead auditors may elect to divide responsibility for the audit under AS 1206. And finally, the potential for a disproportionate impact on smaller audit firms because one, they're less likely to already be performing the procedures described in the amendments, and two, they generally lack the economies of scale to distribute additional fixed costs over many audits. Next, we consider possible research designs and the availability of data. Ideally, we'd like to measure the causal impact of the amended standards. However, because the new requirements take effect for all engagements at the same time, there's no natural control group, which makes identifying a causal impact empirically challenging. Therefore, we expect that our large sample econometric analysis will primarily be descriptive, that is not causal in nature. That analysis is, nevertheless, still useful in understanding changes in audit practice over time and can be complemented through stakeholder outreach designed to delve deeper into the potential drivers of observed trends. At this time, our plan for econometric analysis is to perform a pre-post analysis of other auditor usage, other auditor hours, and deficiency rates on referred work, as well as analyses of differences in some other conventional academic measures of audit and financial reporting quality. Also, as I just indicated, in addition to the large sample econometric analysis, we plan to conduct various forms of stakeholder outreach, including audit firm surveys, engagement partner interviews, audit committee chair interviews, and the like, to understand how stakeholders have experienced the implementation. Next, we consider potential uses of our analysis. First, we expect to provide the board with a timely empirical assessment of the benefits, costs, and unintended consequences associated with the amended standards. This includes an assessment of whether the amendments reduce the rate of audit deficiencies in work performed by other auditors. Additionally, we aim to help the board evaluate whether there is need for more guidance or further changes to the standards. More generally, in the past, data analysis and empirical findings from PIR work have proved useful in developing other audit performance standards, and so we anticipate some positive spillover effects here as well. Finally, we consider any prior directives from the board or the SEC that may commit or obligate the PCAOB to conduct a PIR. As you can see here, in the case of the revised OA standards, there was some language in the SEC's approval order which indicated support for the amendments and an interest among stakeholders in the PCAOB's ongoing monitoring and post-implementation review of the impacts of the revised standards. So now we want to ask for your feedback and open up the discussion for some Q&A. We'll kick the discussion off with a few questions for your consideration. First, have you observed any changes in auditing practice in anticipation of the amended PCAOB standards on the supervision of other auditors? And if so, are there any implications of these changes on audit quality? Second, what analysis around the impact of the amended requirements would you find interesting or useful for PCAOB to conduct? And finally, what types of outreach, for example, surveys, interviews, focus group discussions, might we want to consider? What groups should we elicit feedback from? And what potential effects, for example, impacts on audit processes or unintended consequences might we ask those groups about? We can start the discussion there and open it up to any questions you may have. Thank you again for your time.
Brady.
Thank you for that overview. So I had a couple questions to consider when I was looking at your slide about the deficiency rates on the referred work engagements. So first, just it would be nice to see how that divides between the US GNF and the non-US GNF, just to kind of descriptively understand, are they two working in parallel? Are we seeing problems in one versus the other? And then secondly, you mentioned that divided responsibility audits, even though they're rare, it would also be nice to see as a comparison the deficiency rates for that when you have that case versus not having the divided responsibilities. And then lastly, when I think about the use of other auditors, you know, what is my choice as an auditor when I decide to use another auditor? And you were mentioning, especially during the COVID period, maybe one choice is to try to do it myself, but virtually. I would like to see a comparison of the deficiency rates for those two cases to understand, you know, if my alternative option is to do it myself, am I doing a better job? You know, are we seeing auditors do a better job? And this goes more to problem identification rather than post-implementation review. But because you have these unique circumstances with COVID where we have different cases, I think you can exploit that some more and help us get a better idea of where the problems might be. Thank you.
O'Brien.
Thanks, Jessica. So I agree with some of the questions that Pree's raised, and I do think your observations on some of the reasons, at least for G&F firms, for the reduction you've seen in contrast to the increase of use of other auditors are, they certainly resonate with me relative to COVID and the environment and some of the ability to do more things virtually and the group auditor determining to do things that they might have not done directly in the past. I guess I would, in response to some of your questions, I guess what I would say is that, we're obviously working towards the implementation of ISO 600 and the other auditor standard. While I wouldn't say there are dramatic shifts as a result of the standard in advance of the effective date, there certainly are things that that we've messaged and trained on relative to what's coming that could influence behavior and practice, but the real implementation will happen on next year's 2024 calendar year audits, and in connection with that, we're really looking to use that as an opportunity, even where we've got good practices in place today that are compliant with the new standard, really to reinforce good practices, to think about what we've learned over the last few years from a virtual perspective, making sure that teams are thinking strategically about the right level of involvement in risk assessment and supervision and review consistent with the new requirements of both sets of standards, but also with what we've learned as a result of the COVID environment. And so there's a lot there. I'm actually excited about this, and that I think there is an opportunity here relative to using the new standards as an opportunity prospectively in this space, and it's obviously an important one relative to multi-location audits, but it may be premature to have, there may be sort of qualitative things that you could kind of look into or you could discuss. The couple questions pre-raised I think are good ones, but I think the real observations relative to the new standard will come after the effective, more so after the effective date in connection with 2024 audits.
Susan DeVrath.
Thank you for that presentation. It's very, very interesting. I just had a couple of questions. Number one, when we refer to non-US GNFs, are we still presuming that those are our largest audit firms globally, or are we talking about entirely different firms?
Still the largest firm that we talk about, the amount of 6. It's just that they're at the international affiliate of those 6 firms.
Okay, great. So a couple of things that I had thoughts on. I feel like the PCAOB has gone very global, and it would be nice, I think, to start referring to global firms instead of non-US firms. I think that's something that comes up in other areas and topics. And then a few other things that I found particularly interesting and can't quite put my arms around were when we look at the non-US GNFs, their use goes considerably up over the last 5 years, yet the hours are considerably decreased. So I'm a little curious as to why that would occur, and does that just simply mean that, the practice areas in the non-US locations, when they're in a global location, they probably do more of the work, perhaps in Asian countries and that sort of thing. So I'm not sure that the trend, the way it looks like that's bad, that it's going up, but I'm not sure that's really the case because, they're doing less hours. So if they're most definitely zeroing in on what they're not good at and doing it, that seems to make more sense to me. So kind of going back to the first comment, I'm a little more interested in the deficiencies within breaking out some of those pieces. Thank you.
John Lekovnick.
Just a very small comment on outreach, consistent with everyone else's notes and your explanation. The two audit committees I'm on, one of which is a U.S. and one of which is a European, it happens to be fund management groups. This is increasingly an issue that the audit committees raise with the auditors on how much oversight and attention are you paying to non-domestic, and what are you offshoring in this? And so I think one of your outreach, and I think part of it was when you came out with the proposed standard, it just in all the literature, we all got, have you paid attention to this? And so I think one of the types of outreach you might do is to audit committee chairs as well. That's all. Thank you.
Keisha.
And just to follow up on another outreach opportunity, whether there is any opportunity to leverage the relationships with IFER, because to me, that they're on the other side of the equation. So the audit professor, me, I'm trying to make sure it's completeness, but maybe some outreach just to talk to our counterparts about their involvement for those other auditors. They're kind of overseeing them in those jurisdictions, so there might be some information that can be had and understood from those relationships with those other audit regulators. Thank you.
Preeti.
I missed one other thing I wanted to suggest. So you mentioned that you had some data on the costs. I'm not exactly sure how that breaks down, but it would also be helpful to see some association between these costs and the deficiencies to evaluate if the deficiencies are driven by, people not maybe spending enough time to implement the rules versus the rules not being sufficiently, good enough or whatever, addressing the problems, so to speak. Thank you.
Josh.
Yeah, thanks. Maybe just in response to your first question and maybe building a little bit off what Brian mentioned, I think in addition to kind of the preparation we're all undertaking relative to the PCAOB standard and the international standard, probably many of us are going through the process of implementing the international standard ISO 220 on quality management, which is also having, some impact, to enhance the lead auditor and, his responsibilities related to quality management throughout the engagement. So as you're thinking through the analysis and the impact, that is something that's going on effective for this year's audits. That does have impact on the engagement partners' involvement in resources, compliance with ethical requirements, engagement performance throughout the group. So just something to think about. And as you guys are designing, if there's something we could do to help demonstrate some of the impact that's having, kind of currently happy to do that.
Thank you. Appreciate it.
Thank you so much for that, and thank you, Ricky and Wei. So turning to, we're going to have an introduction to our breakout session that we're going to have today. As mentioned earlier, our Emerging Issues and Auditing Subcommittee has planned discussions on several topics, and I'm happy to turn this over to Preeti to give an introduction to the breakout sessions.
Good morning. Thank you, Barb. My name is Preeti Chowdhury. I'm from the University of Arizona Dhaliwal Reedy School of Accountancy, and I am very happy to be serving as the SEIAG subcommittee leader. I'd like to just start by acknowledging my teammates here, just to make sure everybody knows who they can send additional comments and questions to if that arises over the course of the next year. So virtually we have Jim Hunt, who's joining us, as well as Dane Mott. They serve on the subcommittee. And unfortunately, David Fabricant couldn't be here today, but he also serves with us. And then, of course, Brian Croto also serves with us. So thank you for that. We wanted to start by just making it clear that the views expressed in this breakout session discussion are our own views and do not represent the views of our employers or affiliated organizations. So what we did as a group is we came together and tried to brainstorm what we thought, sort of green light thinking without any direction. What are the maybe most important issues that are coming up, emerging issues for the PCAOB? And as a committee, we came up with these 7 topics: AI, fraud detection, environmental issues, hiring and retaining talent, financial services and banking, China, Hong Kong, and crypto. These were our subcommittee members' views that these are very important issues. So what we did is we asked all of you in the SEIAG to give us your ranking of these issues. Unfortunately, we didn't benefit from having that before we picked our topics, but nicely, or to our advantage, the things you all selected very much aligned with our subcommittee views, in that the top 4 issues we identified included AI, fraud detection, environmental issues, and hiring and retaining talent as emerging issues for the PCAOB. And then we had to select 3, and while we were all very excited about fraud detection, we thought it is possible the PCAOB will select that as its own topic, so we deferred that for another session, and so stay tuned. I expect to have more on that perhaps next time. So we selected AI, environmental issues, and hiring and retaining talent. And so I will have the pleasure of leading this first discussion, which is about the talent drain. So just to give an overview of the scope of the problem as we see it. So over 300,000 U.S. accountants and auditors have left their jobs in the past couple of years, which is about a 17% decline in the industry's employment. And this is expected to perhaps worsen in the horizon as we have a number of baby boomers leaving the workforce, with 75% of CPAs retiring or close to retirement in the next 15 years. As an academic, we've had a lot of discussions about the fact that we're having trouble attracting students towards the accounting major. There's been a significant decline in those interested in the undergraduate and master's degrees, and at some universities, it's been as big as a 50% decline in enrollment. So we are talking very large numbers. So this is important for the firms to know what is coming down the pipeline for them in terms of attracting talent. We see it first, you all see it second. There are a number of reasons that people have brainstormed. This is not meant to be a fully inclusive list. I hope we benefit from our subcommittee discussions. But a number of reasons that have been mentioned: stagnant starting salaries. As you can see on this graph, the starting salaries in accounting lag far behind some of our other business majors. As a personal data point, not to date myself, I graduated in 1999 with an undergrad from UVA, and I also went on for the master's. But my starting salary was about $48,000 in 2000. And fast forward to 2019, my students were getting an average starting salary only $5,000 higher than me in 20 years. That is not good enough, in my opinion. So that just brings it home. Other ideas: onerous requirements of 150 hours. That's been mentioned in terms of the complexity of actually getting the degree and passing the exam. Lack of diversity. I know at my institution we are trying to address that. Work and job appeal is lacking, and I think that's kind of related to what I would call the outdated business model of having to spend a lot of time before you get a return on your investment. So these are some of the ideas for some of the reasons, and I look forward to the breakout discussion. I'm going to now turn it over to my colleague Jim, who is going to talk about breakout session 2.
Well, thank you very much, Preeti, and good morning. Good morning, everyone. I'll attach myself to the disclaimer that Preeti offered and say that we decided in talking in the EAI about the importance of the environmental considerations. And we decided to really break it out from the whole consideration of ESG. We certainly recognize that there are overlaps in the environmental component specifically and ESG taken as a whole, but we thought because of the significant changes that this could represent or will represent for preparers, for potential auditors, potentially for auditors, and ultimately for investors, that we really talk from the specific perspective. So we put together this framework that will hopefully lead to a robust discussion in our breakout session. We thought about the audit considerations in the current environment. If you think about environmental risk as a financial risk, then climate matters are a risk factor currently, and certainly as early as the 1970s, but most recently before their most recent consideration of proposed rules, the SEC provided guidance in 2010 on the consideration of environmental and climate risk. And so we're thinking about those auditing considerations and existing auditing standards, which may be considered applicable as we anticipate going forward. We've also considered the environmental discussion and disclosures that may ultimately be required as the Securities and Exchange Commission moves forward on its proposed regulations, which I understand the latest update of the Securities and Exchange Commission agenda would suggest sometime in the fourth quarter of this year they will become effective. And certainly the discussion is around the financial statements and footnotes, but previously there had been discussion about whether or not disclosures of environmental issues would be in proxy statements or separate documents. And we certainly know that in voluntary disclosures now, there's a great deal of separate documentation being considered. And then, of course, we would like to discuss the role of the PCAOB, which begins, obviously, with investor protection and improved audit quality. And so there's the consideration, hopefully, that we'll get into a good discussion on standard setting, inspection, enforcement, potentially on implementation guidance, and the consideration of attestation standards on environmental limited assurance, even in a voluntary period before they are required. And then the timing dependency, certainly, as I've discussed now a couple of times, there are other regulatory considerations. Each of you in the room probably know that just this week, the ISSB, the International Sustainability Standards Board, finalized IFRS 1 and 2 for disclosures and discussions of financial considerations related to environmental matters. So those are the discussions that we would look forward to in our breakout session. And now, Preeti, I'd hand it over to Brian to discuss the considerations of AI. Thank you.
Thanks for that. And now we'll move on to the discussion around AI. And actually on this one, we're going to have three perspectives to start with. And David Fabricant from Amex, who had a long-planned vacation plan during this time, couldn't be here, but he did pre-record his piece from a preparer perspective, then I'll tee up an auditor perspective, and then we'll turn it over to Dane Mott for an investor perspective. So with that, if I get the technology right, we'll go to David.
Hello, fellow SEIAG members. I hope you're having a great meeting, and I'm sorry I couldn't be there today. I'm sure most of you have read numerous articles about how generative AI has the prospects to revolutionize what we do in finance, across nearly every function in finance, including the accounting function. I keep thinking about how spreadsheets have transformed the way we worked over time by increasing automation and making us more effective and efficient by reducing manual effort and increasing our ability to analyze and produce high-quality outcomes and financial statements. I think Gen AI has an equal, if not greater, ability to be the next major point of transformation for financial statement preparers, and I can see it impacting nearly every accounting role across a range of companies in nearly every industry. I thought I would give you a few examples of some use cases that we are considering. We're thinking about Gen AI for GAAP and tax rule interpretations and helping us write accounting policies and implementation memos. We're thinking about Gen AI for the creation of financial statement footnotes and even populating data in those footnotes. I can see use cases where Gen AI will be performing balance sheet account reconciliations and even monitoring the general ledger for anomalies and early warning indicators. Using the advanced language models, Gen AI will be writing different quantitative and qualitative sections of our 10Qs and 10Ks. Our ability to analyze vast amounts of data, both within the financial ecosystem and across the company, will significantly increase, as well as analyzing data outside of the company. Analyzing customer contracts to assist in determining key accounting triggers could be performed by Gen AI. I can even see use cases where it will help us with the determination of fair values and applying judgments and determining estimates, which means Gen AI would end up supporting and producing accounting outcomes. And this is just the beginning. Going back to my spreadsheet comment, which some of us learned the hard way, requires robust controls. Gen AI will be no different, and certainly a challenge when we begin adopting AI, as it will have to be ICFR compliant not only on day one, but we will also have to have and develop a process for continuous monitoring of those controls month in and month out. We will need to look at our talent and ensure we do our part to upskill them for this new technology. And finally, I do think auditors and preparers will need to work closely together as this technology is implemented, leaving ample time for the auditors to adjust their audit plan and testing procedures, which may include expanding the use of specialists to support the audit.
Sorry, thanks, and with thanks to David for that, maybe I'll transition to the auditor perspective. And I was remiss in not first thanking Preeti for her leadership on all of the subcommittee work that we've been doing. Really appreciate you stepping into the role and doing some of the heavy lifting there. And for any prospective students or students that may go back and listen to this over time, if some of what you're hearing here isn't exciting to you, I don't know what would be in terms of artificial intelligence in the audit and the preparation of financial reporting. This is an exciting space. So anyway, from an auditor perspective, let me just say a few things. You've heard from David relative to the preparer's view and some of what the thinking is there. I thought I'd cover a bit of how we think about that from an audit perspective, how we think about the risks, the governance, the controls, and then briefly some of what we're doing from an auditor perspective, and recognizing that varying firms are in different places and doing different things, and I certainly can't speak on behalf of where everyone in the profession might be, but certainly it's moving very quickly. I'll start with kind of preparers again, just briefly, and not to repeat the things David said, but when you think about the varying forms of AI and the use, whether it be machine learning, generative AI, or the like, when you think about the examples David gave, there's varying forms of AI that are being considered or potentially even used in management's processes. There's already a wide range of use cases. So if you think about intelligent document processing to reading, reading documents, to machine learning, to matching transactions and account reconciliations, or drafting accounting memos, or even helping with the preparation of documentation for books and records. Certainly, David mentioned also preparation of journal entries and thinking about how AI may be used to help inform those processes. There's also a wide range of use cases for the future, and when you think about how far preparers may go and the speed, it's really important to step back and think about where are we today, where are things headed, and what are the risks that we might see, and how do we address those as auditors. I think from what you're hearing, what we're seeing, really at this point, it's a lot of AI being used where it may be used really in enabling and not replacing human judgment, which is obviously hugely important. Different strategies bring different risk profiles and different responses that would be necessary. So it's important, I think, for preparers and their auditors to be aware of where AI may be being used within their organizations. And I think, for example, within our firm, one of the things we're doing is we're asking our teams to make sure they've asked management those questions and they understand how may they be using AI within their teams, and what are they doing relative to the risks and controls and adapting appropriately. When you think about the need for governance over AI, the ability to have explainability, to think about data bias, to think about version control. These are just some of the topics that will require careful attention by both management and auditors. As I think about some of the conversations I've had with preparers and some of the things I've heard them say they've experimented with, or in fact even done as an enabler, that you really do step back and then you ask questions about what are the controls and the implications to your controls. Have you modified your controls to address those risks? Some of the areas that we think about as we begin to think about, whether it be traditional automated solutions or whether you think about introducing AI, you certainly think about accuracy and the potential for introducing data that results in inaccurate outcomes. You think about what I'll call version control, although that's a complicated topic in the context of AI. You think about explainability and how explainable the model is and maybe over time, and then bias are just some of the thornier issues. Overall, I think preparers will need to have, as I mentioned, an AI governance structure to manage these risks, and having effective strategies around this will be important because I think many people with inside organizations and outside organizations will begin to experiment again, whether it be machine learning, whether it be other forms of AI or generative AI. And I've mentioned obviously the importance of the obligations from an ICFR and DC&P perspective as well. In our own processes, we've been thinking about explainability, and we've developed a framework for how we would begin to think about areas where we may be introducing forms of machine learning or AI over time in the conduct of our work. The less explainable, I think, the processes are, or the AI, the effect of AI may be, the more I think you're using it probably more as an accelerator versus actually something, so it assists perhaps the auditor in performing an action, as opposed to being something that does a final preparation or final analysis. So, for example, a model that suggests the trial balance account maps to certain account statements might be something that you would use, but then you would be checking that. As auditors, we do recognize there's significant change as a result of AI, and certainly that brings new risks. So we've certainly announced plans ourselves, and I know other firms are doing the same relative to upskilling our people and to equip them with the knowledge that they'll need and the skills that they'll need to evaluate the effects of AI. This is in addition to efforts we've taken over the years relative to upskilling our people digitally, and then obviously we're thinking about methodology and tool enhancements and the like. We've begun to experiment within our own firm just on using machine learning and certain aspects of AI in our work, but it's important to note that we're not using it in any way that replaces human judgment, and when I say experimenting, we're not relying on it in any way relative to the work that we're conducting without the appropriate human involvement. We do continue to think about how we could use other forms of AI, including generative AI, including in our system of quality management, and instead of inevitable that others will use AI and expand in those ways as well. I expect that other firms will have similar stories that they'll share, and really look forward to those discussions. Initial use cases do start to highlight the power behind AI, but also the challenges. So, for instance, using AI to tag, index, and map audit and accounting literature to enhance search functionality can get to the desired outcome more quickly, possibly. It also can create risks. So, you think about the recent New York Times article that some have talked about, where a lawyer submitted a 10-page brief citing court decisions. The problem was they used ChatGPT, which invented the citations, and they asked whether they were real, and it confirmed they were real. However, they were not. So this is just one example that does show some of the risks that one would need to think about. And then applying a familiar concept, I would just say to what we've done as auditors for decades of what could go wrong will help us identify new risks for preparers and auditors as we continue to explore this space. So in my view, the time is really right for this dialogue. I think it's an important dialogue. I think there's room and space for all of us to be taking actions, including, I think, the PCAOB, relative to the risks that are beginning to emerge in this space and the importance of the attention that's placed on it. So with that, let me turn it over, Dane, to you relative to the investor perspective.
Great. Thanks, Brian. I think the first principle here is first, do no harm. I can think of AI's adoption kind of akin to the idea of autonomous driverless vehicles. When it's a function where safety is highly critical, we have to kind of be very measured in how we adopt it. And so, going back to the car analogy, we shouldn't be in a rush to get rid of the steering wheel. I think folks will be adopting AI across the entire, all the stakeholders in the financial process, all the financial reporting process, the user process. But I think it's going to be a long time before, for mission critical functions, where we can kind of trust AI on its own. Everything that it's doing, we're going to have to verify. We're not at a point where trust is really an option. And to that point, if any of you have experimented with AI, you've gone in and put in questions where about topics where you have a level of expertise, often they'll come back with very compelling answers, but then they're also highly inaccurate. So, there's that issue there where, you'll have for lack of a better word, more fake news, if you will, entering into the system, and it might be harder for a layman to kind of navigate, the difference between fact and fiction. The way I'm thinking of AI at this point is thinking of it as a semi-competent assistant. Right now, you'll ask it a question, but oftentimes, like as I mentioned, it comes back with inaccurate information. So I think over the long term, it has the ability to increase our productivity, but in the short term, there's also a lot of additional functions that are going to be necessary to, a lot of time and effort that's going to have to be spent verifying things that it comes back with. I think it's helpful. You can think of the types of queries that could be done today and in the future. You could do a query where you have it review a company's filings and then summarize what it thinks the key risks are at the company and generate a list of questions if you were going to have a conversation with the CEO and CFO. I don't think you'd go into that meeting with those specific questions. I think you'd look at those questions, use those as creative ideas, things to consider, and you'd refine from there. But again, it's not an area where you trust it. Another issue is you could have it review all the filings across a whole industry and say, okay, look at all the CAMs that the auditors have disclosed across the industry, and for this particular company, what are some CAMs that they might be neglecting to identify at that company? So it might be helpful in a comparative element. I think, if we come back to what the investors' ultimate concern is, we're interested in fraud discovery from the audit profession. And today, as we've mentioned at previous meetings, only 4% of frauds are currently identified by the auditor. And I think, we can think about that. Could we get to a point where AI is surpassing the auditor in fraud discovery? Well, if they're discovering 4% at this point, that time might come relatively quickly, where investors and users are applying the AI to the financials and, having it identify things that lead them to ask questions and then drill further and find issues. I think, still for the foreseeable future, whistleblowers are going to be the dominant, revealer of fraud. Today, they reveal 42% of frauds. And, it'll be a good amount of time before AI is surpassing that. Another element is just like, hey, also recognize that this is an AI arms race. Everyone's going to have to invest in it across the complex. All the stakeholders, including the PCAOB, will also have to start putting resources, time, people into starting to experiment and eventually implement the tools. But if ultimately those with the best AI have the ability to identify frauds at a higher rate than the auditor and the profession in general, that also is a risk to the profession where it could kind of hurt profession credibility if you have it coming from folks using the best AI and seeing things that the auditors aren't seeing. And the last thing I'll just point out is, still when we think about fraud, a lot of the sources of fraud happen before the journal entries ever entered. It comes down to management's judgment on key assumptions that are made and things like valuation and so on and so forth. So, we shouldn't see this tool as kind of the end-all be-all. It's a tool. And, just as we've kind of evolved to use spreadsheets, we'll evolve to incorporate AI more and more, but perhaps it's more evolution than revolution. So with that, I'll stop there.
Oh, thank you, everyone. So we have 10 minutes for a combined break and for everyone to have a few minutes to transition to the breakout sessions. The breakout sessions are not open to the public and will not be live streamed. The public portion of this meeting will resume after lunch at 1:15 p.m. We do ask that all members return to this room at 5 minutes after 1 for a brief ethics update. And with that, I will see you all after the breakout sessions and lunch.